Have you ever wondered why the stock market sometimes soars with optimism and other times plunges into despair? These fluctuations are driven by bull and bear markets, key concepts every investor should grasp. By understanding these cycles, you can better manage your investments, mitigate risks, and seize opportunities. In this video, we'll delve into the characteristics of bull and bear markets, explore their causes, and provide practical investment strategies for each phase. So, let's start with the basics. A bull market is a period when prices in the stock market are rising or are expected to rise. It's called a bull market because of the way a bull attacks, by thrusting its horns upward. When people talk about a bull market, they often refer to stocks, but it can apply to any market, whether it's real estate, bonds, or even commodities like gold. The key thing to remember is that a bull market is characterized by optimism, investor confidence, and expectations that strong results will continue. On the other hand, a bear market is the opposite. It's a period when prices are falling or are expected to fall. The term comes from the way a bear attacks, by swiping its paws downward. In a bear market, there's widespread pessimism, and investors often expect poor performance to continue. This can lead to a self-fulfilling prophecy where the fear of losses leads to more selling, driving prices even lower. So now, you might be wondering, why does this matter to you? Well, understanding whether we're in a bull or bear market can help you make better investment decisions. For example, in a bull market, you might be more inclined to invest in stocks, hoping to ride the wave of rising prices. In a bear market, you might be more cautious, looking to protect your investments from falling prices. Also, let's talk about what drives these markets. Bull and bear markets are influenced by a variety of factors, including economic indicators like GDP growth, unemployment rates, and inflation. For instance, if the economy is growing, companies are making profits, and unemployment is low, people tend to be more optimistic and invest more, leading to a bull market. Conversely, if the economy is shrinking, companies are struggling, and unemployment is high, people tend to be more pessimistic and sell off their investments, leading to a bear market. And there's also the role of investor sentiment. Sometimes, markets can be driven more by emotions than by fundamentals. In a bull market, optimism can feed on itself, with rising prices leading to more buying and even higher prices. In a bear market, fear can do the same, with falling prices leading to more selling and even lower prices. This is why it's important to stay informed and try to keep your emotions in check when making investment decisions. Now, let's look at some historical examples to make this more concrete. One of the most famous bull markets in recent history started in 2009, after the financial crisis. It lasted over a decade, with the stock market reaching new highs and many investors seeing significant gains. This period was characterized by economic recovery, low interest rates, and strong corporate earnings. On the flip side, the 2008 financial crisis is a textbook example of a bear market. Stock prices plummeted, and many people lost significant portions of their investments. This period was marked by economic recession, high unemployment, and a lot of fear and uncertainty in the markets. So then, how can you tell if we're in a bull or bear market right now? There are a few indicators you can look at. First, consider the overall trend in stock prices. If prices have been rising steadily over several months or years, we're likely in a bull market. If they've been falling, we're likely in a bear market. Also, look at economic indicators like GDP growth, unemployment, and inflation. Strong economic indicators often signal a bull market, while weak indicators can signal a bear market. And next, let's talk about some strategies for investing in bull and bear markets. In a bull market, one strategy is to buy and hold. This means buying stocks and holding onto them as their prices rise. The idea is that as long as the market continues to go up, your investments will increase in value. Another strategy is to buy on the dips. Even in a bull market, prices can fluctuate, so buying when prices temporarily drop can be a good way to get in at a lower price. In a bear market, one strategy is to diversify your investments. This means spreading your money across different types of investments, like stocks, bonds, and real estate, to reduce your risk. Another strategy is to invest in defensive stocks. These are stocks and companies that tend to do well even when the economy is struggling, like utilities or consumer staples. What's more, some investors choose to stay out of the market during bear markets. They might move their money into safer investments like bonds or cash until they believe the market has stabilized. This can help protect your investments from large losses, but it also means you might miss out on gains if the market turns around sooner than expected. Besides these strategies, it's also important to keep a long-term perspective. Markets go through cycles of ups and downs, and while bear markets can be tough, they are often followed by bull markets. Staying focused on your long-term goals and not getting too caught up in short-term fluctuations can help you stay on track. Another thing to consider is your own risk tolerance. Some people are more comfortable with risk than others, and it's important to invest in a way that matches your comfort level. If you're not sure what your risk tolerance is, you might want to talk to a financial advisor. They can help you understand your risk tolerance and create an investment plan that fits your needs. Investing can be complex, and a financial advisor can provide valuable insights and help you make informed decisions. So, remember that bull and bear markets are natural parts of the economic cycle. They can be influenced by a variety of factors, including economic indicators and investor sentiment. Understanding these markets can help you make better investment decisions and stay focused on your long-term goals. And finally, stay informed and keep your emotions in check. Markets can be driven by emotions, and making decisions based on fear or greed can lead to poor investment decisions. Stay focused on your long-term goals, and remember that markets go through cycles. If you have any questions or want to share your own experiences, feel free to leave a comment. And, as always, stay informed and make smart investment decisions. See you next time.